Welcome to the Global Experts Network learning platform. I am truly delighted to guide you through this 10-minute masterclass on Module 1, Foundations of Investment Analysis. Today, we begin our comprehensive course by building the essential bedrock of your financial expertise, starting from the very first principles of the global financial ecosystem. This module is designed to build your core understanding of investing and financial markets. We will learn the fundamental concepts, terminology, and frameworks that form the foundation of professional investment analysis, covering everything from market functions to complex investment vehicles. By the end of this session, you will be able to define investment analysis, explain the functions of financial markets, identify major asset classes, and understand the vital role that analysts play in the industry. We will also master the concepts of market efficiency and the various market structures. Investment analysis is the systematic evaluation of securities and opportunities to determine their value and potential. It involves rigorous valuation to find intrinsic worth, detailed risk assessment to quantify uncertainty, and return estimation to forecast potential gains or losses. A critical first step is distinguishing investment from speculation. As a professional, your focus must be on the long-term horizon, using fundamental research to manage and calculate risk. Speculation, by contrast, is often short-term and relies on less predictable market timing and trends. In this table, we see that true investment is research-driven with a goal of long-term wealth accumulation. Speculation involves higher, less predictable risks and seeks quick profits. Mastering this distinction is what defines a successful professional analyst. The role of an investment analyst is diverse. You are a finance professional who researches securities, analyzes data, and builds complex financial models to perform valuations. Your ultimate goal is to provide the insights that guide high-stakes investment decisions. We must also understand the industry players. Buy-side firms like asset managers and hedge funds make the final investment decisions for portfolios. Sell-side firms, primarily investment banks and brokerages, provide the research and facilitate the actual trades within the market. Financial markets are the platforms where buyers and sellers trade assets like stocks, bonds, and currencies. They serve four essential functions: price discovery, providing liquidity, allocating capital to productive uses, and offering sophisticated instruments for risk management and hedging. These functions ensure that capital flows where it is most needed. Price discovery determines fair values. Liquidity enables easy trading, and risk management allows participants to protect themselves against market volatility using various financial instruments. When categorizing these markets, we look at maturity. Capital markets handle long-term financing with stocks and bonds, involving higher risk and return. Money markets handle short-term liquidity, typically under 1 year, with lower-risk instruments like T-bills and commercial paper. We also distinguish between the primary market, where new securities are issued and companies raise capital directly, and the secondary market, where existing securities are traded among investors on exchanges like the NYSE and NASDAQ. The market is composed of a vast array of participants, from individual traders to governments and market makers. A key theory guiding our understanding is the efficient market hypothesis, which states that asset prices fully reflect all available information, making it impossible to consistently beat the market average. Market participants range from individual savers to institutional investors like mutual funds and insurance companies. Corporations raise capital, while governments issue bonds. Financial intermediaries and market makers provide the critical liquidity by quoting buy and sell prices. EMH comes in three forms: weak form, where prices reflect past data; semi-strong form, where prices reflect all public information; and strong form, where prices reflect all information, including insider insights. Understanding these is vital for any investment strategy. Equities, or stocks, represent ownership in a corporation and a claim on its future earnings. Common stock grants voting rights and variable dividends, while preferred stock offers priority in dividends and liquidation, but usually without the voting power. They offer high return potential but carry higher volatility. Fixed income investments, primarily bonds, are debt securities where the issuer owes you interest and the principal at maturity. For many investors, pooled vehicles like mutual funds and ETFs are the primary entry point, offering easy diversification across broad portfolios of assets. Bonds can be issued by national governments as treasury bonds, by companies to raise capital, or by local governments as municipal bonds. Their key characteristics are lower risk than stocks, regular interest income, and a clearly defined maturity date. Comparing mutual funds and ETFs, we see differences in trading and fees. ETFs trade intraday like stocks and often have lower fees and better tax efficiency. Both vehicles allow investors to pool their money into diversified, professionally managed portfolios. Derivatives are financial contracts whose value is derived from an underlying asset like a stock or commodity. Common types include options, futures, forwards, and swaps. They are powerful tools for hedging risk or gaining leveraged exposure to market movements. Alternative investments like real estate and commodities go beyond traditional markets to offer unique diversification. However, we must always respect the fundamental risk-return trade-off. Higher potential returns inevitably come with higher risk, moving from treasury bills up to emerging markets. Alternatives include physical real estate, commodities like gold and oil, and sophisticated strategies like hedge funds and private equity. Even digital assets like cryptocurrency fall into this category, providing benefits that often move independently of traditional stock and bond markets. The risk-return trade-off is a foundational principle. Treasury bills sit at the low-risk, low-return end, while emerging markets and small-cap stocks sit at the high-risk, high-return end. As an analyst, you must find the optimal balance for your client's risk tolerance. To mitigate risk, we use diversification, the practice of spreading investments across various assets. By allocating across different classes, sectors, and geographies, we ensure that we don't put all our eggs in one basket, reducing the impact of any single asset's failure. Investment strategies are broadly categorized as active or passive. Active investing seeks to outperform the market through frequent trading and careful stock picking, while passive investing simply aims to match market returns. We also contrast value investing, which seeks undervalued companies, with growth investing, which focuses on high-potential startups. Active investing requires deep research and analysis, but comes with higher costs. Passive investing, using index funds and ETFs, requires less time and expertise, and typically has lower fees and taxes. Choosing the right approach depends on the investor's goals and resources. Value investing focuses on undervalued companies in mature industries with low PE ratios. Growth investing focuses on high-growth companies, often in tech, that reinvest their earnings rather than paying dividends. Both styles have their place in a well-constructed portfolio. Market indices track the performance of specific groups of stocks, providing benchmarks for overall market health. The S&P 500 tracks 500 large U.S. companies, while the NASDAQ Composite is a technology-heavy index. These are essential tools for measuring relative performance. Professional analysts must constantly monitor key economic indicators to assess market conditions. GDP, unemployment rates, inflation measured by CPI, and interest rates all provide the critical macro context needed to make informed investment decisions and adjust portfolio strategies. Key indicators include GDP for total output, the unemployment rate for workforce health, and CPI for inflation. Interest rates, consumer confidence, and the manufacturing index also provide vital data on the economic cycle and future market trends. The investment process is a continuous loop. First, setting objectives and risk tolerance. Second, developing an investment policy. Third, analyzing and selecting individual securities. Fourth, constructing the portfolio. And fifth, monitoring and rebalancing as market conditions change. Finally, we must respect the regulatory environment. In the U.S., bodies like the SEC, FINRA, the Federal Reserve, and the CFTC oversee various segments of the market to protect investors and maintain the integrity of the financial system. Mastering professional terminology is your first step toward effective communication in this field. We will now apply everything we have learned to a practical case study, examining how to match an investment strategy to a specific investor's profile and long-term goals. Essential terms include bull and bear markets, volatility, liquidity, and market cap. Understanding these, along with dividend yield and PE ratios, will allow you to read financial reports and market news with a professional eye. Let's consider Sarah, a 28-year-old with a stable income and a 35-year horizon for retirement. Given her moderate risk tolerance and long-term goal, what asset allocation and strategy would you recommend? Think about the mix of stocks, bonds, and ETFs she might need. To summarize Module 1, investment analysis is systematic evaluation. Financial markets facilitate capital flow. Major asset classes are equities, bonds, and alternatives. And crucially, risk and return are directly related, while diversification is our best tool for reducing overall portfolio risk. Take a moment to test your knowledge with these review questions. Can you explain the difference between investment and speculation? Can you describe the three forms of the efficient market hypothesis? Or explain why diversification is so vital? These are the foundational concepts you must carry forward. Review these questions carefully. Mastery of these concepts is the prerequisite for moving on to more advanced analysis. Understanding common versus preferred stock, or the difference between mutual funds and ETFs, is critical for your future success as an analyst. Module 1 is now complete. You have successfully built the foundations of investment analysis. This is a significant milestone in your professional development, and you are now prepared to dive deeper into the practical application of these principles in the next phase of the course. Thank you for your dedication to learning today. To stay ahead of shifting market trends and receive the latest insights from our network, please subscribe to the SNB Experts YouTube channel. I look forward to seeing you in Module 2, Financial Statement Analysis. Goodbye for now, and keep learning.